I have returned with another insightful and entertaining video. It's going to change how you look at options altogether. Okay, in the last segment, we looked at options contract selection and we were looking at time. If you missed that one, link is in the description. So today, what we're going to do to build on that is we need the second component of how to properly select a contract option, and that is volatility. Okay, so by the end of this video, you're going to understand everything that you need to know about volatility, how it works, and how you can use it in addition to time to select the proper options contract for your objective. To begin, what we have to do is define the terms so that we understand exactly what we're talking about. So we need to understand two aspects of volatility, okay? One is historical volatility, and the second is implied. Okay. Now, historical volatility has to do with the underlying asset, or in this case, the stock upon which the derivative is based, okay, that being the option. All right, so now, historical volatility is just a mathematical construct, a formula that analyzes the deviation from a mean in share prices over a given period of time. That's what it does. This will be a number that will be assigned. So the underlying asset will have a certain historical volatility based on what it has done in the past. All right. Now, implied volatility has to do with the option contract itself. Now, this implied volatility is how the market is arriving at the value of the premium, which is the amount that's the cost to either buy or, to buy the option contract, which is the right but not the obligation to purchase the stock at a predetermined price called the striking price. Okay, so this implied volatility is much more complicated, and it's usually arrived at with something called the Black-Scholes model, and it's a pricing model. All right, and so Black-Scholes is based on a bunch of different things. One is a risk-free rate of interest, okay? So an interest rate, time, okay, so the time to expiration, and volatility, okay? All right, so Black-Scholes takes into account those aspects and arrives at a certain implied volatility for that specific contract for this underlying stock. Now, each contract will have, because of these all are different for different striking prices, different terms to expiration, they're all going to be different. So your implied volatility for different contracts in the same stock are going to be different. Okay. So now we understand that. If it's really confusing, all you have to remember is that historical volatility pertains to the stock. Implied volatility pertains to the option. Okay. So what happens then when we look at this, okay, so in terms of selecting a contract, now because they are derivatives of price, and they fluctuate based on those aspects of interest rates, time, and the underlying asset volatility, then we need to make sure that we don't overpay for the premium. We don't pay too much. So we have basically what you call cheap premium, and expensive. Well, how do you determine that? How do I determine if the option is cheap or inexpensive, or if it's overinflated based on what the market is expecting the underlying asset to do? All right, well, if we take a look at a graph then, okay, so here, let's say, we're going to have, this is historical volatility. This is HV, okay? Now, if implied volatility, which is IV, If implied volatility is greater than historical volatility, the option is considered to be expensive. That means you're taking a look at the current volatility in the underlying stock. But implied volatility, the market is expecting movement. Okay, because of that, premiums will be very expensive. Okay. Now, if we take a look at the opposite of that, all right, if we have historical volatility, all right, and implied volatility, all right, if implied volatility is less than historical volatility, the option is considered to be cheap. Therefore, it will be less expensive. All right. Now, so that's how you want to use historical versus implied volatility to determine if the option that you're buying or selling is expensive or cheap. Now, if you're selling them, then obviously you want to sell expensive options. You want to buy cheap options. Okay. So that's how we're going to use that to select. Now, the problem with this is we now involve delta. Okay, so the next thing that we need to look at, now that we understand exactly what implied and historical volatility do, the next thing we need to look at is delta, and then we can put this together. Okay, delta is one of the Greeks that every option has. And the delta is very simply is the amount of appreciation theoretically that the option will have given a $1 move in the underlying asset, in this case the stock. So if I have stock ABC, okay, and it is currently $40, all right, and my option XYZ has a delta of 60. This means that if ABC appreciates $1, then I will get a 60-cent move in the option contract. Okay, very important that you understand that. What this relates to is the leverage of options. So options have a leverage goes, it's not linear. So leverage will steadily increase as the option goes from out of the money, meaning that it's currently the option contract pricing is less than the strike, whatever that striking price is for the option. As that goes into the money, meaning, let's say the strike price is down here, current prices are above the striking price, then delta will steadily increase until something called parity hits, which means the option is now at 1-for-1, meaning you now have, for every dollar move in the underlying, you get a $1 move in the option contract. Okay, that's called parity. Okay. So what we want to do is, now that we understand that, you got to take a look at what happens when we select. Okay, so what do we need to do to select? So when for this using volatility, so what we want basically an inexpensive contract. Okay. And we want one with sufficient delta to capture that the best part of the underlying move. Okay, so we want a slightly in the money delta. Now, what does that mean? All right, the problem with delta, like we said, is delta is not linear. And just like we looked at when we checked out time, decay is not linear. Nothing is linear when it comes to options contracts. It's always moving around, and it depends on the relationship of time, interest rates, and the underlying asset. Okay, so because all these things are moving, all right, so the problem with delta is if we have stock ABC that's currently at 40, okay, what most people do, and the reason nobody makes any money buying options, is because what they'll try to do is they'll say, oh, well, stock's currently at 40. I expect it to go to 60. And they'll come up here and they'll buy an out of the money call that's really cheap. It's not necessarily cheap in terms of volatility because they don't know how to figure that. It's cheap by dollar amount. Doesn't mean anything. Okay. Now the problem is, here's what happens when you look at delta. If the market does not move and it stays around 40, maybe between 40 and 50, the delta of this call will remain very, very subdued. And that means that your contract will not appreciate alongside the appreciation in the stock. And you also have time eating away, nipping at your heels. That's the problem. So cheap out of the money calls that are money cheap, not necessarily volatility cheap, are the problem. So the way to get around this is with your slightly in the money call option. So what we do is if the stock price of ABC is at 40, I'm going to look at like a 42 to a 45 delta contract, right? Or striking price rather. Okay. So I'm going to look at if my stock is at 40, I'm going to look at 42 to 45 as the delta. Now what that means is I'm slightly in the money and I should have a delta of 65 to probably like 70. Now what happens is that hits the sweet spot. So if I look at as my price steadily increases here, okay, so if I'm looking at like there's 40, here's 45, here's 50, okay, I'm hitting the sweet spot in that delta where as the price steadily increases, so will my option immediately from the beginning, okay? I will get immediate price increase. What we looked at before is if we have very, very low delta, this is called, we won't get that, and that's called delta burn. So what happens is the stock moves, but the option contract does not significantly increase in price, and you waste a big chunk of the early move in the stock because you haven't selected the proper option. Okay, so again, the idea is we want low volatility, low implied volatility vis-a-vis historical volatility. And the reason that is because here's the real bitch of options, and one of the things that people don't understand makes it very difficult to make money, even if you know how to trade direction. Okay, as prices generally increase, you have a commensurate decrease in volatility. All right. Now, as we know now about how volatility is measured, this means that your option, as the stock rallies, the contract is going to get cheaper in terms of volatility. So this is called volatility burn. So what happens is, depending on which contract you choose, you can have an increase in price, a drop in volatility because you've purchased an expensive option. And the contract will not appreciate commensurate with the stock. Okay, so again, what we're trying to do here is we're trying to arrive at a surrogate, and we've talked about this before. All right, a surrogate for shares. We want the anytime you're trading an option vis-a-vis the underlying asset. So if you're looking, even if you're looking to do a spread or definitely directional trading, which is the way I do it, you basically want your surrogate to be like, you want your option to behave like the share. You want it to increase in value immediately as the stock price moves. You don't want volatility burn and you don't want delta burn. Okay, so in order to do that, we need cheap volatility, and that's historical volatility versus implied. All right. So that means we want high historical volatility, low implied volatility. And then as far as our delta, we want a slightly in the money contract around 60, 65 or so. Okay. So again, this will give us the best possible shot at making money immediately when the stock takes off. No, it's not the cheapest one. But again, you avoid the volatility burn and you avoid the delta burn. That's exactly how you choose volatility to select the proper contract to achieve your objective. Don't leave home without it, and then make sure you're also looking at time as well. And in the future, we'll take a look at some other ways that we can best select the most desirable option and how to use them. But for now, definitely get on the right side of volatility. Thanks a lot, everybody. Have a great day. I'll see you soon.